Let's do our case study 7 together and look at each step in order to arrive at the producer's profits. Our budget in this case is $25 million. We will not be deducting any in-kind services, and the strike price is therefore going to be the same amount. It's the budget, $25 million. Let's look first at our funding components. At this moment, for our funding, we do not have any US pre-sales or any US revenues that we can use in order to finance our production costs. So therefore, the number is 0. For international, we have projections of 70% of our budget, and that is 70% of $25 million. That gets us to $17,500,000. So our gross revenues in relation to the project evaluation and our projections in order to put our finance plan together would therefore be $17,500,000, $17,500,000. How do our pre-sales look? So in order for us to establish our pre-sales that later we go and get a bank loan for, we'll look at them. Our international pre-sales are $7.5 million. The down payment for that comes to $1.5 million, and the sales fee is $187,500 in our case. All we have available at this very moment when we do pre-sales and have our distributors sign our contracts is what these distributors pay us at the time of signing the contract, and that's just the down payment. And our sales agent did not defer any sales fees, so that means the sales fees are due on the down payment. So we're deducting $187,500, which leaves us with $1,312,500 that we will be later adding to our finance plan. So let's take a look at our senior loan. What does the bank loan look like? And remember, the bank loan, our senior loan, is a combination of a pre-sale loan, that is a loan that is cash flowing our pre-sales, and a gap loan, that's a loan against our unsold rights. So let's look at that. We have pre-sales done for $7.5 million, but remember that the bank will apply a discounting, so they will actually only give us 90%. They will acknowledge that we have received 20% of our pre-sale contracts already from the distributor. So in this case, they will allow us to deduct this $1.5 million, and they will not charge interest on that. So our gross cash flow loan in this case is $5,250,000. The interest on this gross pre-sale loan would be 8% for the term, which is $420,000. So we deduct this from the gross cash flow loan, and what we have available to cover our production cost is therefore $4,830,000. That's all we have right now. So we have the down payment of $1.5 million minus the sales fees, and we have the net cash flow loan. Now let's see what else we get from the bank. The bank is going to see that we have $5 million available as a collateral for from the unsold rights. And because this collateral amount is not more than 20% of the budget, the bank will give us 20% in full, meaning the 50% of the unsold rights. So that's $5 million. The bank will deduct 8% interest fee, so that's $400,000, and a loan fee of $50,000. So what we end up with as a gap loan net is $4,550,000. So if we now add our net pre-sale loan to cash flow of pre-sale contracts and our net gap loan, the loan against our unsold rights, we get to receive $9,380,000 that we can use to cover our production costs. And you see down there, there is the gross senior loan. That amount, the $10,250,000, is the amount we keep in mind because we're going to have to pay that back later in our recoupment schedule. Let's look at our finance sources. Let's establish them. We did have a net cash flow loan from our bank, which was $9,380,000. We also had a net down payment available to us, which was $1,312,500. We do have a production incentive, and we'll go into the calculation on the next slide, of $7,650,000. We do have crowdfunding available to us of $750,000. That's a cash investment. That's a monetary investment. That's not an in-kind service. The fee that we're being charged, the admin fee, is 15% of that, so $112,500 are being deducted. This leaves us with $637,500 available for us at closing. We also received some sponsorship financing. We got $500,000. We have to pay the advertising agency 25% of that, so $125,000 are being deducted. This gets us to a net amount of $375,000, of which we are getting 50% at closing, and the other 50% will be given to us when the movie is being delivered to the sponsor. We did have a mezzanine junior loan of 10% of the budget, which gets us to $2.5 million. There were no interest due, but there was an executive producer fee that needs to be paid from it. That's $50,000, which leaves us with $2,450,000. Now the subtotal, if we take all these finance sources and sum them up, is $21,617,500. So the equity investment that we need in order to cover the balance to reach $25 million is therefore $3,382,500, and it's 14% of our budget of $25 million. Our case study mentions that only $9 million of our production amount of our production cost is actually spent in Germany. That means that only $9 million are subject to a production incentive, because that's all that's being spent there. So 35% incentive of $9 million gets us to $3,150,000 that we will be getting from Germany. In Belgium, we're actually only spending $10 million of our budget. So therefore, only $10 million are subject to the Belgian tax credit provision of 45%. So that means we'll get $4.5 million from Belgium. So if we sum this up, our tax incentive from Germany and Belgium together for our movie of $25 million is $7,650,000. And again, this is a non-recoupable incentive. We do not have to pay this back. So we funded our movie, we produced it, all is well, and now we are delivering the movie and are looking at our revenues. Now, we did have $17.5 million from international distribution revenues. Of that, we already received $1.5 million in down payments, which leaves us with $16 million in international revenues. The U.S. distribution revenues to us, the producers, are $5,381,250, and how we get there, you'll see on the next slide. But our adjusted gross revenues, which is U.S. plus domestic, is $21,381,250. Now remember that brand integration, the second payment, is now due, so we can add $187,500, and altogether we will be receiving $21,568,750. So now let's take a look at how the U.S. distribution revenues are calculated. So when we look at our revenue calculations, we are again looking at our foreign revenues, which are comprised of the $7.5 million in pre-sales that we have reached. We now have sold all our unsold rights because the movie is ready, which were $10 million. We are deducting what we already received from the distributors, which is $1.5 million. So if we look at our international revenues, we end up with $16 million available to us. Now the US is going to look a little different, because in this case, we're actually taking the movie out theatrically. And we have in the US theatrical box office of $70 million. That means ticket sales revenues were $70 million. Now of that, the theater owner, the exhibitor, will keep 35%, which leaves our studio with 65%. So 65% of 70 million is 45,500,000. Now the studio will charge distribution fee of 25% of its share. That's 25% of 45,500,000, which is 11,375,000 that have to be paid to the studio in addition. That leaves us with an adjusted gross revenue of 34,125,000, because we have to deduct obviously the distribution fee from the studio share of the box office revenues. Now our deal with the studio is that we get to keep 35% of that. Now 35% of what that net amount is would be 11,943,750. That's what we're getting at this point. Now we did have a P&A investor who charges us $5,250,000 for the release campaign, plus a premium on the investment of $1,312,500. So all in all, we do owe the P&A investor $6,562,500, which is being deducted from our share of the U.S. revenues. So that leaves us with $5,381,250 from the U.S. And in combination with our international revenues, we now have $21,238,250. So that's the amount that we have from distribution revenues. We are, of course, looking at other revenues in a minute, but this is what we have from our distribution revenues. So let's look at our revenues. Altogether, we had distribution revenues of $21,381,250. At this point, now that our movie is ready, finished, and is delivered, the sponsor is paying us the balance due to us of $187,500, which gets us to a total gross revenues of $21,568,750. So all these revenues are now hitting the collection account, and the collection agent will charge 1% of whatever comes into the collection account. So the fee to the collection agent in this case is $215,687 for that reason. Next in line is our sales agent. The sales agent is charging us 12.5% of 16 million, not 17,500,000, because we already paid him on 1,500,000 down payment. So all we're paying him is 12.5% of the international revenues of $16 million. We're not paying him on the domestic deal. On the distribution expenses, we agreed a cap to be applicable with the sales agent of $150,000. So that's all we pay here. We don't pay a percentage. We just pay an amount of $150,000 in distribution expenses. So altogether, our sales agent has a $2,150,000 payment coming to him. Next in line in our recoupment waterfall is our bank loan. In this case, we're paying back the gross bank loan, of course, because we're now paying all the interest that is due on the loan. So we're paying $10,250,000 to our bank. Next in line is our union residuals. In our case, we work with the Screen Actors Guild, because all our actors are SAG members. So the Screen Actors Guild SAG is charging $150,000 residuals, which we are paying to them at this moment. Next in line in our waterfall would be our junior loan. That's our mezzanine loan. And it would be the gross amount of $2,250,000. There is a premium that is due on this money, so we now have to pay 15% of that in addition, which is $375,000. So all in all, we're paying a junior loan, including premium, of $2,875,000. Next in line would be deferments if we had any. We don't have any, so we're not paying any deferments at this moment, but it's good for you to know this is where you would be paying deferments. Now, altogether, our expenses are $19,699,687.50. So how do we share in our profits? Let's first figure out how we get to profits. And how we get to profit is we are taking all our revenues and we're deducting all our expenses. That gets us to our net revenues. So all our revenues were $21,568,750. All our expenses were $19,699,687.50. So if we're deducting, we are getting to a net revenue amount of $1,869,62.50. So now we're sharing the profits. Our equity investor had given us an investment that reflected exactly how much percentage. I can tell you. The equity investor gave us 13.53% of our budget. And in order to figure out the equity investors' profit participation, we divide that by 2, because 50% of this percentage would be applicable as a back-end participation. 50% of the percentage invested in relation to the budget is going to be the profit participation percentage. So that gets us to the 6.8%, which comes to 126,442.08 cents. The mezzanine investor does not get any profit participation. If we would have had deferments that wanted profits, that would be also shared, but we didn't have any. The tenant is requiring 30% of our net revenue, so that is 560,718.75. And our crowdfunder, who gave us some cash to cover production costs, is wanting 3% of profits, so that gets them 56,071.88 cents. So altogether, all our profit participations come to 743,232.70 cents, which leaves us, the producer, with 1,125,829.80 cents.